My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Let's be able to make friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate and to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. I've been searching for words that can explain what happened to Apple stock today. What sent it up more than 7%, a staggering amount. And I think I may have actually come up with it. We've all heard people talk about the conventional wisdom, but if there's conventional wisdom, maybe there should be a flip side too. Hey, why don't we call it conventional stupidity? Yeah, there's a gigantic cup runneth over amount of conventional stupidity when it comes to the stock of Apple, and we have to explore where it comes from because it's really hurting us. And it also explains today's terrific action, the most important stock in the world, a stock move that had awesome pin action. Dow dipping 121 points, but the S&P 500 advancing 0.27%, and the tech-heavy NASDAQ jumping 0.88%, all averages aided by the gigantic move in the consumer tech company. Those are record closes for the S&P and the NASDAQ. I think we need to explore the schizophrenic nature of it all. 24 hours ago, Apple stock was plunging, just in free fall. Why? Because conventional wisdom held that there was nothing new to be had or heard about from their Worldwide Developers Conference. Nothing. Conventional wisdom said that the whole thing was a yawner. The lack of some killer new way to do something. The surrender that Apple's made to others in the field of artificial intelligence. The absence of something, anything that would make you want to buy a new iPhone. Genmoji, I mean, to them, that's just Siri as a court jester. Some note-taking thing, perhaps? Oh, how about a dash of privacy? Like anybody cares if they push ads to me. If I say I like the Eagles, they push Eagle stuff to me. Wow, great. No. According to these people, Apple has to be pure as driven snow. So you know what it means, driven snow? It means you can't raise numbers. Because as Tim Cook told me, the campus was buzzing. Yeah, well, what are you supposed to do with that? Yeah, Cook kept saying everything's personal. How much money do we make with that? How quaint. Oh, and Apple Intelligence, AI for the rest of us? It sounds like Festivus. It totally made a holiday for the rest of us. Conventional wisdom said it was nothing but a gigantic nothing burger. Ketchup, maybe? Today, though, Apple's market capitalization came up to a cool $215 billion. One session, it gained $215 billion. Little dry. We have to ask ourselves, was yesterday's reaction not conventional wisdom, but conventional stupidity at work? I think so. You know why? Because we found out today that what mattered to the consumer the whole time was one gigantic question, and that's what mattered to the stock, too. Will I have to upgrade? Now, try. After taking what Apple's offering in totality with the iPhone 16, I think we can estimate that of the more than 1 billion people who have an iPhone, a huge percentage, if not a preponderance, will upgrade. Why? Well, let's go over it. And maybe it's because of the Genmoji feature. So derided yesterday. Allow us to send personalized emojis because boy, oh boy, are we ever sick of looking at the off-the-shelf emojis that now look like there's something from the 60s. Smiley faces? These iPhone 16 emojis are serious emojis right from our photos. Because of Siri. Yes, Siri, no longer the court jester. Like everything related to generative AI, it will just keep getting to know you better and better and better. It's your pal, it's your friend, it's your companion. It's the voice you wanted a decade ago, but with the computing power that simply wasn't existing. Now we've got computing power in space. How about that note-taking thing? Oh, hey, let's just say you're in a meeting, and you're frantically trying to take things down. It's all like, if it's like me, it's all chicken scratch. You're lucky if it's barely legible. Not everyone went to school that insisted on great penmanship. Guess what? Those days are over. You let Apple Notes take down the meeting or the phone call, and then you get it transcribed instantly. That way you get to focus on what was said, not on trying to decipher your own handwriting. And by the way, it turns out that the personal AI stuff, it is about privacy. You don't want to give up all your personal data to ChatGPT, even as it gives up its data to you. It's not an even trade. It can't follow your IP wherever you go. Yes! It's not going to push you anything about the Eagles or anything, no advertising, no clothing, no gardening stuff. You can learn about what you need, and that's it. You give the ChatGPT the Heisman. Plus, Tim Cook told me to stay tuned. Hey, maybe there's more to come. Maybe with Google's Gemini? After all, that stock flew up when OpenAI came up because OpenAI wasn't able to lock up Apple. I know that Elon Musk is unsatisfied. He wants to ban Apple's devices if they use OpenAI. To which I say, good, let him eat Samsung. And let's get something really straight about conventional stupidity. Even today, with Apple stock soaring, I heard endlessly about how Apple's still way behind its rivals. Behind what? Because they aren't spending $60 billion on data centers? Because they're not giving Oracle a gigantic check like everybody else? Because they aren't writing multi-billion-dollar checks to NVIDIA? Because they aren't part of some arms race that may or may not produce actual profits? This isn't a nothing burger. This is the real deal, people. This is a double cheeseburger with fried onions and special sauce. It's an Impossible Burger, the one that ousted Joey Chestnut from the hot dog eating competition. How dumb can these analysts and commentators be? What's really behind the stupidity? I mean, did these analysts go to business school to get a degree in being a moron? Did Larry Moe and Curly start he talking my mouthful. Did Larry Moe and Curly start hedge funds so they could come up on air and spew idiocy in your general direction? I think, coming from that world, it's simple. Analysts are uncomfortable figuring out what people might want. They're uncomfortable doing anything but analyzing the enterprise and enterprise hardware and software and putting it in a spreadsheet and pressing a button. But Apple's a consumer-oriented company. It didn't produce a device that improved the sales funnel. It didn't give you a robust dashboard to ensure that you have replenished the cable knit sweaters in time for the next order. How the heck will you know if your salespeople are really trying to sell those HVAC systems with this device? A lot good Serial would do when you're trying to stop the hack for United Health. As the analysts see it, we don't want no steak and emojis. We want serious, seamless onboarding so we can land and expand with a software as a service model that's robust enough to deliver services and applications quickly. This device gives us nothing like that. It's a consumer product. How are we supposed to stack this up against other software-contained hardware, enterprise? Are we really supposed to figure out how many people will upgrade their iPhones because of envy, because of whimsy, because of necessity? Give me a break. They don't want to do that work. It's too subjective. Yet that's who you heard from yesterday. People want Apple to be part of the AI arms race and offer something that's corporate, something where you can put pen to paper and come up with 10,000 enterprises that will each need 15,000 devices. They want to be able to model those sales and move on. They want Apple to play by their rules. They want you to trade it non-wasted Sunday. That's the source of the negativity that you were force-fed yesterday. You got the genuine homespun wisdom that comes from people who simply don't want to admit that Tim Cook, that Apple, that the developers, that the writers actually want to keep selling to what's been their key demographic the whole time, the consumer. They're not chasing the enterprise, and these Apple haters have no idea how to evaluate a tech company that's like that. They don't know anything about the consumer. Bottom line. You think I like repeating over and over again that people should just own Apple, not trade it? You think I like parroting the Tim Cook line about the wonderment of it all and how much people love the privacy, the personalization, the indispensability of something that people spend all day telling you was just a total bust from the get-go? Darn straight. You bet I do. Hey, why don't we go to Ron in Tennessee, please? Ron.
Hey, Jim, I just wanted to say first, thank you for all you've done. You helped me feed my 4 children after I saw you on the first Iron Man movie. Anyway,
you like that? I got a hat. Everyone else made hundreds of thousands of dollars. I got a hat. Stark Industries.
Well, my question is, I wanted to start looking into Berkshire Hathaway, and I didn't know which IPO you would suggest first.
Well, I mean, if you want, I think you just own Berkshire Hathaway, period. You just own Berkshire B. And that'll be terrific, and you'll do great. I want to thank you for those kind words. Iron Man was a long time ago. How the way I like that. I broke that cup. Wasn't that something? Got written up by HR. All right, let's go to Ann in Indiana. Ann.
Hey, Jim. Thanks for taking my call. I'm a Happy Club member.
Oh, thank you. Thank you.
So I've seen you do this so many times, you know, how you put together this whole pastiche to make a decision about a company, you know, because one quarter they seem to have pricing power and share, and then, you know, they're losing pricing power and their comps are down. So with Starbucks, I'm more interested in a way in the process, but are they in the penalty box now, would you say?
Yes, they are. I mean, I talked with Jeff Marks. I mean, it's down $1.70 today. Jeff Marks said we don't have desire to buy it yet until they get something right. And we don't want to throw good money after bad, which is exactly what it is right now. All right, look, I thank you for those kind words and being a member of the club. I've said it once, and I kind of like saying it again. Own Apple, don't trade it. Well, everybody, tonight, Eli Lilly's got some positive news in the pipeline for the new Alzheimer's treatment. I'm giving you my latest on the healthcare standout, fresh off the progress. Then, one pharma player has been making strides since his corner office change-up. I'll reveal the name and why this large cap is worth watching. And later, I'm checking with Coterra top brass to see where the energy company stands after reporting some record-breaking efficiency. So stay with Cramer!
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Everybody knows I love Eli Lilly, mainly because it's developed what I believe could be the biggest drug of all time. And that's the revolutionary GLP-1 treatment for weight loss, diabetes, and possibly many other indications. Right now it goes by a Mounjaro for diabetes, Zepbound for obesity. Lilly's gotten to its current $823 billion valuation almost entirely on the strength of this medication, and for good reason. For those of you who've owned it for the long haul, like my charitable trust, well, the stock's made us a fortune. But there's more to Lilly than just the GLP-1 revolution. They're also working on what could be a very exciting Alzheimer's drug called donanemab. Now, just yesterday, the FDA's Peripheral and Central Nervous Systems Drugs Advisory Committee, or ADCOM for short, held a meeting on donanemab, and the results, they surpassed all expectations. And that's why I want to give you an update on this one, because it's new. Because I know many viewers, along with members of the CNBC Investing Club, now own Eli Lilly, given my endless endorsements of the stock, of which, by the way, I am proud of. And look, this outcome meeting went great. I mean, honestly, it was a very good outcome for Lilly, with 11-member advisory committee voting unanimously on both of the two questions posed by the FDA, that they said, one, the drug is effective, and two, the benefits of donanemab outweigh the risk. Keep that in mind. They outweigh the risk because there's some good things happening here. More important, we really didn't know how this advisory committee would rule. Certainly wasn't a given. Last week, the FDA released background documents ahead of the meeting, and there were a couple of areas of concern for the bulls. For example, it looked like Lilly's Alzheimer's drug might potentially get dinged on safety grounds. In the clinical trial that the advisory committee was relying on, 3 patients who took donanemab died from a condition known as amyloid-related imaging abnormalities, while there were 0 deaths from that cause in the placebo group. In fact, there were more deaths generally in the group that got the drug than in the placebo group. That's usually a sign that it's not going to get approved. Granted, we're talking about Alzheimer's disease, so the people taking the drug aren't exactly young, but you never want to see more deaths in the group that gets the actual medication. And that's why I feared it might not be approved. The second issue is more of a technicality. With the FDA did not agree with Lilly's decision to change the primary endpoint of the clinical trial. Now, I don't want to get too deep in the woods here, but Lilly originally said it would use a measurement called the Clinical Dementia Rating - sum of boxes to evaluate how well their drug works. But then the company changed to a different measurement of cognitive function called the Integrated Alzheimer's Disease Rating Scale. Now, we know the FDA had previously said that they didn't like that move. Nobody likes it when you move the goalposts, right? But in the end, those concerns apparently didn't amount to much at all, as the advisory committee ruled that the safety concerns were generally consistent with the class of drugs that donanemab belongs to. These are drugs that fight Alzheimer's by clearing out a type of plaque that forms in the brain called amyloid beta. Okay, it's not just plaque, it's amyloid beta plaque. Even better, the advisory committee said that donanemab's efficacy outweighs any safety risk that might exist. Now, that's because the efficacy numbers are really impressive. Based on the clinical trial, we know this drug can slow the cognitive and functional decline of people with early-stage Alzheimer's by 35% over an 18-month period. Imagine having that window for yourself. I mean, this is a horrible disease. As the different types of measurement systems, Lilly's case was aided by the fact that the drug still demonstrated statistically significant results based on the FDA's preferred system, even as Lilly used a different system for the formal evaluation of the drug against its primary endpoint. It looks good with either metric, though. Now, Eli Lilly's next step getting formal approval from the FDA. And while the agency doesn't technically have to agree with the advisory committee's decision, it would certainly be highly unusual for them to overrule an 11-0 decision in favor of the drug. That hardly ever happens. In fact, the FDA usually just follows the recommendation. The last time I can remember the FDA disagreeing with the advisory committee was 3 years ago when an AdCom panel advised the agency against approving Biogen's first Alzheimer's drug. But the FDA approved it anyway. Very controversial decision. But I think they did it because there's so few actual treatments for this disease. Now, though, the FDA's got the AdCom panel unanimously recommending that they give Lilly's Alzheimer's drug the thumbs up. So I would be shocked if it doesn't get approved. After that would come the launch and how we'd have to see this drug does versus the competition. If approved, donanemab would be the third Alzheimer's treatment targeting amyloid plaque to make the market following two drugs that were jointly developed by Biogen and Japanese drug maker Eisai, called Aduhelm and Leqembi. Now, Aduhelm is the one that the AdCom panel recommended the FDA avoid approving. Leqembi, though, is considered a much better drug than Aduhelm. Right now, it's effectively the standard of care for early-stage Alzheimer's. Now, how about these two? Well, we're going to have to see how much market share donanemab, or whatever Lilly decides to call it once it goes commercial, probably get rid of that name, can carve out. We're now seeing some analysts argue that Biogen's Leqembi seems safer because it has a slightly lower risk of amyloid-related imaging abnormalities. Then again, donanemab slowed the progression of early-stage Alzheimer's by 35%. Leqembi only slowed it by 28% over the same period. That is statistically wide. It's big, and it matters. Clearly, the FDA's advisory panel thought the efficacy of Lilly's drug means it's worth the risk. These are very big differences. But for now, I'll just say that yesterday's advisory committee decision represents an incremental positive for Eli Lilly and donanemab, and of course, anyone with early-stage Alzheimer's disease. Frankly, as far as the stock goes, the Alzheimer's drug it's not that important for the moment. Certainly not when you compare it to the Mounjaro/Zepbound GLP-1 revolution. When you look at what the analysts are expecting, they're projecting $331 million in donanemab sales next year before growing to $705 million in 2026. Pretty good, but not earth-shaking. Now, if you want some context, the analysts are looking for $26 billion from Mounjaro and Zepbound combined next year. However, Lilly's stock has already had a huge run on those GLP-1 numbers. And as we told members of the investment club, they need to prove to Wall Street that they've got something more in the pipeline. I think this advisory committee decision on the Alzheimer's drug does precisely that. As a shareholder, I am grateful for these projections, by the way, when estimates to stay as low as possible. Here's the bottom line. Right now, Eli Lilly is an $823 billion behemoth. And I truly believe it's ultimately headed to $1 trillion valuation, mostly fueled by the GLP-1 revolution. But yesterday, we got still more proof that Lilly's not merely a one-trick pony. If you want a deeper dive into this charitable trust holding, I do suggest that you join the investing club, where we do the homework so you don't have to do quite so much research on your own. We can reach the same conclusion together. Mad Money's back in.
Coming up, we now know Lilly, so how about a new idea? It's part 2 of Cramer's series on Big Pharma. Next.
You know, I think the economy is slowing down because we're not getting any help from the Fed until the unemployment rate goes substantially higher. And that's why you need some recession-resistant stocks in your portfolio as we head toward the second half of the year. Now, some stocks that have, let's say, zero linkage with the economy, stocks like the best of Big Pharma. So all week, I'm highlighting my favorite names in the industry, other than Eli Lilly, which we talked about earlier. We own Lilly for the Charitable Trust, and I love it, but it's already had a great run. There's no denying it. If you think Lilly feels too obvious, or you just want something that might have more room to play catch-up, then this week I'm giving you a menu of high-quality pharma names. So last night I covered one I've been thinking about for the Charitable Trust. It's driving me crazy that I didn't pull the triggers. The AstraZeneca, big British drug maker that recently released some fabulous clinical trial data for 3 potential major cancer treatments, got a standing O at the big ASCO conference. I like this one so much I can't believe how inexpensive it is in the out years. But tonight I want to circle back to another one that I really like. This one's in the United States, and it's Merck. Because other than Lilly, Merck's been among the best-performing large-cap drug stocks out there. So up nearly 73% in the past 3 years, while the iShares Pharmaceuticals ETF gained only 7% over the same period, and Healthcare Select Spider Fund was up only 18%. It's almost triple the gain you would have gotten from the S&P 500, too, up almost 27%. Why has Merck been such a tremendous outperformer? Well, I don't think it's a coincidence that it's all happened since Rob Davis took over as CEO in July of 2021, before adding the chairman title roughly a year and a half later. before Davis took over, Merck was all about its phenomenal oncology franchise, was led by Keytruda, which first got approved back in 2014 and became the world's best-selling drug last year with a staggering $25 billion in sales. If you had a drug like that, you'd build your whole company around it, too. What's more remarkable is that Keytruda just keeps defying the law of large numbers as it gets approved for more and more types of cancer. Last year, it had 19% sales growth as doctors started using it more frequently for earlier stage cancers, and it launched in more countries around the world. And it keeps growing. In the latest quarter, Keytruda sales were up 20% year over year, coming in well ahead of what the analysts were looking for. Don't forget, this was the first cancer treatment that's been approved for any type of solid tumor that's metastasized, as long as it has the right genetic markers. Now, Merck's latest quarter was just terrific, but Keytruda did account for nearly half of its revenue beat. Even better, though, they keep finding new uses for this incredible platform. Merck's done so many Keytruda trials, they can quickly study its impact on new types of cancer. Right now, for instance, they've got 30 phase 3 trials for Keytruda alone across 10 different types of tumors. You're going to see data point after data point after data point that makes you want to own Merck stock. Again, any pharmaceutical company would kill to have this drug, and this is a very big but, Keytruda is also Merck's biggest problem, because it starts losing patent protection in 2028. Now, while 4 years may sound to you like a long time, remember that drug companies need to prepare for many years in advance if they want to come up with new drugs to replace their old ones that are going off patent. Sure, Keytruda has made the company a fortune, but what happens when it starts facing generic competition and pricing collapses? Take a look at AbbVie's Humira, which was previously the biggest drug in the world for the better part of a decade, before being eclipsed by COVID vaccines and then Keytruda. Humira's sales peaked at $21.2 billion in 2022, and then it started facing generic competition last year, so its sales quickly fell to $14.4 billion. And this year, analysts expected it to only do $9.6 billion, and that's actually pretty much more than I thought it could do. Merck still has 4 years to make every penny it can from Keytruda, but after that, the company's looking at a bunch of down years unless they can find some replacements to make up for the patent cliff. Fortunately, from the moment Rob Davis took over in 2021, he's been on a mission to put together Merck's next-generation drug portfolio with the goal of replacing any revenue that rolls off as Keytruda starts facing generic competition, and he's going to do it. This process started back in late 2021 when Merck acquired a company called Acceleron Pharma, $11.5 billion, bolstering its cardiovascular pipeline. That deal's already started to pay off. Just a couple of months ago, Merck received FDA approval for Winrevair. We had Rob on the show when this happened. It's a treatment that Acceleron developed for pulmonary arterial hypertension or high blood pressure in the lungs. And that's a condition that can become life-threatening if it gets worse, and it almost always does get worse, sadly. Right now, the analysts are betting this drug can do nearly $2 billion in sales by next year and more than $4 billion in 2027. I think those numbers are low. Next, Merck acquired one that really excited me called Prometheus Biosciences for $10.8 billion in June of last year, a transaction that should help strengthen their immunology pipeline. Prometheus' lead drug candidate is a humanized monoclonal antibody that targets a certain protein associated with intestinal inflammation and fibrosis. Merck's looking to advance the drug as a treatment for immune-mediated diseases like ulcerative colitis, Crohn's disease, and other autoimmune conditions. These big opportunities. And under Davis's leadership, the company continued its takeover binge with a couple of smaller deals announced so far this year. In early January, Merck told us they're going to snap up Harpoon Therapeutics for roughly $650 million in order to bolster and diversify their oncology pipeline. Harpoon is an early-stage drug with a new approach to treating small cell lung cancer and neuroendocrine tumors. Sounds good. Just 2 weeks ago, Merck announced a deal to acquire iBio. That's a privately held ophthalmology-focused biotech play for up to $3 billion, with $1.3 billion up front and as much as $1.7 billion in future milestone payments if iBio hits certain developmental, regulatory, and commercial milestones. Now, this deal will give Merck significantly more exposure to ophthalmology, yet another step in diversifying the business away from its Keytruda addiction. Remember, and I'm being cute here, but Keytruda is a really amazing drug, but you got to have a bigger pipe. Of course, it's not like Merck's forgotten how to develop their own drugs either. As the American Society of Clinical Oncology Conference Management highlighted a bunch of other cancer treatments that, together with what's left of Keytruda, should allow the company to do over $20 billion in annual oncology sales by the mid-2030s. In the end, Merck's been tremendously successful in recent years because they came up with a miracle cancer treatment, Keytruda, that blows everybody else away, works for so many different types of tumors that it would take way too long for me to list them all. But in a few years, Merck's stock will become a victim of its own success as investors start worrying about what happens when Keytruda goes off patent. Luckily, CEO Rob Davis refuses to sit on his laurels. He's made a series of very smart acquisitions to bolster that pipeline, some of which are already paying off. And he's got some great stuff in development internally, too. So let me give you the bottom line on Merck. If you believe Rob Davis can pull this off, and I do, then Merck deserves to be one of the best stories in big pharma right now and maybe should be in your portfolio. It's got exclusivity on the biggest drug in the world for 4 more years, one that's still growing at 20% clip. And once the patents expire, Merck should have a whole new generation of blockbuster drugs ready to replace it, just as it should. Stackwell in Washington. Stackwell.
But booyah, Jim. What's the dealie, Jimmy Chili?
Well, I don't know. You fill me in, my friend. Give it to me. Hit me.
Next time, long time, man. Hey, man, I'll let you know, man. Hey, look, I did a whole song about you, Jim, called Like Jim Cramer, letting you know, man, we love you out here, man. So I'm just telling you, man.
Let's, you just send that to me. I don't know. I'm like, what are you, like a WhatsApp thing or something, you know? And then we're like, man, play a clip. We'll play a little clip there. Homage to Stackwell.
Bulls get money, man. Hey, because I'm telling you, man, what's the difference between haters and potatoes out here, man, on you, man?
Wow, I don't know. Fill me in.
They're both greasy.
Hey. All right, how about a stock?
All right, so look, man, I'm going to get down to business. I'm going to tell you, I got 6 in one hand, half a dozen in another. Between the cyber attacks and extra dividend payouts, I'm overweight by averaging in, so I need to know, am I barking up the wrong tree or am I on the right track, Jim? With the ticker symbol UNH. All
right, UNH can do no wrong in the eyes of the market. I think that hack was horrendous. I think that they've managed to be able to get by without ever having to even come on TV and admit to what happened and own up and figure out who got hurt by it and address this stuff because it's outrageous. That said, you got a winner because nothing ever touches UNH. Wow. All right. With its combination of a great CEO, Rob Davis, and a strong drug pipeline, I think Merck deserves to be one of the best stories in big pharma right now. I'm partial to Lilly, yes. I like AstraZeneca. Maybe I like too many drug stocks, but I think the economy's slow, and that's what you do. Much more Mad Money Head. The CEO of Coterra Energy, hey, oil and gas, is joining me to break down what's ahead for the group after oil's mixed action in the front half of the year, but natural gas spiking. Not only even tomorrow's Fed meeting, I'm taking a closer look at some economic signals that could impact the possibility of future rate cuts. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. After a day where the price of natural gas shot up more than 8%, it's worth remembering that some oil and gas producers have the flexibility to pivot to wherever the money's being made and done so efficiently. Take Coterra Energy, the exploration production play that was created when Capital Oil and Gas merged with Cimarex back in 2021. Now, we own Coterra for the Chapel Trust in parts because it's evenly split between oil and gas, and that's what we want. When the company reported a little over a month ago, they delivered a nice earnings beat with management raising their full-year oil production forecast. Stock rallied nicely. And I bet Coterra can keep delivering because, frankly, they can always reallocate resources depending on where oil, natural gas, and nat gas liquids end up trading. Do not take it from me, though. Let's check in with Tom Jordan. He's the chairman, president, and CEO of Coterra Energy. Find out more. Mr. Jordan, welcome back to Mad Money.
Afternoon, Jim.
Okay, so first, let's just get one thing straight. I know there are people who are saying, well, wait a second, they don't have all the, they didn't make a big nat gas bet, so now they're not going to be doing as well. Tom, what you told me was you're going to do things as efficiently as possible, but with people, if they would just step back for a second, they would realize that there really is no independent oil and gas producer that is as well set up for this environment as yours.
Jim, that's certainly our position here at Coterra. But as always, we like to speak through results. We've shown that we can pivot capital from gas to oil, oil to gas as conditions warrant. We have low cost of supply. And we have an organization that, quite frankly, is built for that kind of nimbleness.
Well, to me, what the hallmark of your company is that CapEx stays between 175 and 195, but the growth is 5% a year in oil. I mean, that's kind of what I'm looking for from someone who has pledged to be as an efficient custodian of our money as shareholders as possible. That's what you're doing.
That's exactly what we're doing, Jim. We're not in the business to be static. We think we need to present to our owners consistent, profitable growth. And all three of those words are well chosen. Our assets and cash flow balance gives us consistency and the opportunity profitability is underpinned by really good investment decisions. And then we want to grow. I mean, we do want to, if you own a share of Coterra, we want it to be more valuable next year than it is this year. That's our mandate.
Okay, so when you see something like an 8% gain today in nat gas, I don't want to micromanage or ask you to micromanage, but does someone at your outfit say, you know what, Tom, this might be a good chance to sell a little bit forward or sell some sort of a hedge because they're really the ramp up is not necessarily rational?
We're looking at our hedge position, and irrational exuberance is what markets tend to do from time to time. I'll say this, Jim, it's really hard to look at the gas macro situation and not be deeply optimistic. I mean, whether we're talking about the increased demands of data centers and the electricity growth that's projected, the LNG exports that are opening up, it's really, really difficult to construct a bearish case for natural gas. That said, we do use hedges to manage our risk, and we're looking at that really hard right now.
All right, I'm glad you mentioned the data centers because I've been speaking with a very good banker today who was saying to me, you have no idea how many data centers are being put up in the Southeast. And I said, I really don't. I thought the data centers would be near where the companies are. And the banker said, no, not at all. They're just going where the power is the cheapest and where there's the most abundant natural gas. And I'm thinking to myself, Coterra is the way to play data centers, for heaven's sake.
Well, that's certainly our viewpoint. We're looking at this long and hard. We have tremendous ability to deliver natural gas for decades, either the Northeast, the Mid-Continent, or Texas. And I think ultimately what you're going to see is data centers that not only gravitate near population, but ultimately will gravitate near the energy source. It's a lot easier to build fiber optic to carry those bits than it is to build natural gas pipelines. So I think you're going to see data centers spring up near production.
I am kind of surprised that at a certain point we don't see what I regard as being a deal between a natural gas company and a data center company. I mean, why not? They're spending fortunes to put windmills up, and they're doing that themselves. Why not contact directly a nat gas company, line it up at a consistent price for the next 5 years so you don't have to worry about it?
Well, we're looking at that long and hard, as you can imagine. As I think many of our peers are. We're going to see that. It just makes too much sense, and ultimately logic will prevail on that. And you said 5 years or more. There's a lot of natural gas in this country ready to be brought to market. I would look out a decade or more in terms of secure supply against a reasonable contract that's win-win for the data center and the producer.
Yeah, I think you have to. I mean, when I think about, let's say you have a hot summer. Let's say that that you have some anticipation of LNG capacity increases coming on in the first part of next year, and you're the person who's the CFO of one of these major either the data center REITs or a company that's building data centers like mad. It's almost as if the missing piece of the puzzle is how much is variable here. I can lock in that variation for multiple years, and then I don't have to think about what my raw cost is.
It's about managing risk. And certainly wind and solar are going to be a big part of that growing energy mix. But there are periods of time when the sun is not shining and the wind is not blowing. We certainly saw that in Europe in the fall of 2021 and put them in a really bad position. So natural gas needs to be a part of this solution. It's dispatchable. It provides that baseline security. And it's, quite frankly, a really economical power source.
All right, well, let's go back to the oil side for a second. OPEC does what it does, not really understandable to people. War premium goes down, even though there's no sign to the end of the war in Gaza. We don't know exactly what our government's doing with the SPR. In that vacuum, oil prices go down and not up. I must be missing something.
Well, there's so many elements to this. I mean, OPEC came out. The reasonable forecasters will tell you that there are about 6 million barrels a day off the market at OPEC, spare capacity. Now, what they said a week and a half ago was that about 3.66 of that was going to continue to be withheld, but that about 2.2 could slowly come onto the market. And that kind of panicked everybody. And then the Saudis came out and gave some clarification. So, when it comes to oil markets, I think one has to be calm, One has to be confident in the American producer and our ability to continue to do what we've done over the last decade. And I think that calmness has really shown itself in geopolitical oil markets. I mean, it's you mentioned, this conflict in the Middle East. 20 years ago, we'd have seen $120 oil with this type of event. But really, because of the psychology that's changed in oil markets, predominantly because of the American producer, oil markets tend to be patient and calm.
Well, one last question. Is it imaginable that the price of 27, 28 to you is the same as the price of 25 when it comes to buying back stock? Because it really isn't that much different.
We look at value, quite frankly, on anything we do. Right now, we think Coterra is a great value in the marketplace. And, that's why we're doing what we're doing, what we discussed. But, the price of our stock is going to be set by the market. And our job is to convince the market that it's a very valuable entity.
Well, we sure think it is. I want to thank you, Tom Jordan, Chairman, President, CEO of Coterra Energy. You're a rational person in a business that had sometimes been very irrational. Thank you for coming on the show.
Well, that's high compliment, Jim. Thank you very much.
Yeah, you deserve it. Mad Money's back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time. It's time for the lightning round. Quick answer. Back protocol. It's in the start. Tell about my social code. No, close talk one step by step. Play this up. And then the lightning round is over. Are you ready, Ski? Time for the lightning round. Quick, let's start with Troop T in Texas. Troop T.
DraftKings, is it a sell or a hold?
No, it's a buy, DraftKings. It's come down all the way. I'm not worried about Illinois. I think it's in good shape. Thank you for the call, Sharon in Minnesota. Sharon.
Booyah, Jim.
Booyah.
When they ask about Next Tracker, whether you think it's going to be going higher.
I think Next Tracker is terrific. I felt like we were going to try to buy it for the channel. Trust it's just got away from us again. If it comes down, I think we may have to slap someone. I need to go to Corey in Maryland. Corey.
Hey, booyah, Jim. Hey, a couple of weeks ago, you gave me your take on ARM, and I appreciate it. Hey, so give me your take on ticker MU, Micron.
Oh, I think Micron's going much higher. They've got the lowest cost of production. They've got a terrific CEO, and it's an inexpensive stock. Let's go to Paul in California. Paul.
ConocoPhillips, Jim.
If you have to own an oil company, I say you own ConocoPhillips. Now we're going to Chris in California. Chris.
Hey, Jim. I'm looking for Chevron.
I like Chevron because it's got a 4% yield. I don't like it for the upside as much as Conoco, but I like that dividend. Dennis in New Jersey. Dennis.
Booyah, Jimmy Chill. How you doing?
Chill, man. Good. How about you?
Can't complain. No one listens anyway, but you got to help me. My average cost on this is $760, and I don't know whether to buy more, sell, or hold BlackRock.
All right, I can tell you this. I don't know about your exact position, but I like BlackRock very much. I think Larry Fink has done a terrific job, and the stock seems ridiculously inexpensive to me versus all of the future prospects they had. Now we're going to go to Gloria in Florida. Gloria.
Hi, first-time caller, long-time viewer.
Okay.
Jim, you've helped make my significant other, Chris, a multimillionaire over 20 years. So now it's my turn.
Sure.
Which is the better investment, Chipotle Mexican Grill or Portillo's?
That's an easy call. Chipotle Mexican Grill. Portillo's has just been one giant letdown. Horrible. You know what? The people who run Portillo's should be ashamed because, man, their food tastes great and that stock is awful. Let's go to Joe in New Jersey. Joe.
Hello, Mr. Cramer.
Yo, Joe, what's up?
Thank you so much for taking my call.
Of course.
Yeah. With the near 52-week highs, is Pan American Silver a buy?
It is the cheapest silver stock there is, and I do like it, but I'm not as big a silver fan as I am a gold fan. Hey, why don't we go to Lynette in Michigan while we're on? Lynette.
Hi, Jim.
Lynette.
I am an older income investor, and I invest for the long haul. Is this a good time to invest in Vail Mountain Resorts?
I like the contrary approach you're taking. They screwed up in pricing. They can always roll that back. It yields 4.9. I think you're right to do it. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, are prices finally coming down? Cramer goes around the horn of the economy for clues. Next.
I think the Fed's committed to keeping money tight for the foreseeable future, but we'll find out tomorrow when the jury returns in the guise of Fed Chief Jay Powell. It's pretty easy to stay tight here. The backbone of the U.S. economy is small business, and small business optimism is the highest it's been all year. That means more hiring on top of the 272,000 people who got jobs last month. Hard to imagine getting rate cuts when small business is that optimistic. Instead, the Fed needs to be obviously vigilant against inflation. Natural gas prices spiked today. There's been less drilling, so that won't reverse easily. The median sale price of homes is up about 30% since 2019. That's an inauspicious number for certain, although it used to be 40%, so at least we're headed in the right direction. So yes, it's easy for Powell to leave rates higher for longer, at least on the surface. But you know me, I look at the stocks, and the stocks are actually saying otherwise. Consider the stock of Cleveland-Cliffs, an amalgam of all sorts of steel. That thing's getting clubbed, down almost 26% for the year and off about 8 points from its $23 peak. Cleveland-Cliffs has been annihilated. Now, we're starting to get downgrades. Fellow steelmaker Nucor's down more than 10% for the year. These are real-world situations, not surveys. They represent a lack of demand that will mean lower prices for many important goods down the road. Iron's down big, too. According to data from the St. Louis Fed on pricing for property casualty insurance premiums, one of the most intractable sources of inflation, these premiums are finally rolling over. At last, that won't be a problem. Commodities, lumber rolling over, iron rolling over, nickel rolling over, wheat, sugar, soy getting clobbered. Corn, a key commodity because you need it for animal feed to get meat and poultry, it's down big. Cotton, the indicator of the intractable inflationary apparel category, is now down big from its 2024 highs. Even copper, seen as the most integral of cost for the data center, is getting pummeled. China had been a voracious consumer of copper, but now it's cutting back on all prices as part of a state-sponsored plan. Hey, if it helps us beat inflation, I'll take it. So much for the copper super cycle. It's natural to believe that autos will be next. Too many pieces of cars are coming down in price. When you see these building block prices coming down, you have to start thinking that everything could roll over, even autos, even housing, because the commodities don't weaken like this unless there's a problem with demand. So I think the Fed has every right to be vigilant against inflation, especially with such strong job growth last month. But the big hiring binge in May, actually, if you break it down, came from government and healthcare, which don't depend on the broader economy. There's a bit of strength in travel and hospitality, but those, I believe, are still part of that revenge travel movement left over from COVID. Almost all other industries were static. Again, something that happens before the rollover. These are the brown shoots, that figures and will explain why some economists keep clinging to a September rate cut. I think these lower prices have to go through a pig and a python style before we see the Fed take any action. But they'll have to take action if the downward spiral continues. It's likely, though, because, believe it or not, we're still dealing with shortages that stem from the pandemic, and they're finally winding down. We don't have enough people to do everything we need because of retirement without replenishment of the labor pool. It's just not the way it used to be. All that said, prices are coming down. Companies that don't lower them will lose business. It's the brutal natural order of things, and it's going to play out within the next year. The only wild card is immigration. If the policies are random and the enforcement near to non-existent, then wages, the stickiest of all inflation problems, will come down too, at which point the Fed can really start cutting rates. Remember, the Fed has to take it all in. I don't envy Jay Powell, but I like him. I trust him, and I believe he'll figure things out. Why? Because he's done it before, and he now deserves the benefit of the doubt. I like to say there's always a bull market somewhere. I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.